Good morning. Happy Easter to everyone. 423, 2011, 7:23 a.m. Pacific Standard Time. What we have here for MMTs is on a standard technical analysis so that we know how the hedge fund manager community and the institutional manager community is going to be reacting to this weekly chart. On their they make decisions based on standard technical analysis. They don't have anything else to make decisions on. They're not market makers like you. So we know how they think, and we also know exactly what they're going to do based on what their educational levels are and how they make decisions and processes. The bigger money trades Google, so therefore what I would like to clearly point out is that they're going to look at this blue MACD bar, which is only minus 1.7. That's a weekly sell signal, because it is. The percent DS is down in oversold areas below 20. It's at 16.97. That's a positive. It would have to start turning around immediately. Not only that, as far as the weekly price action weekly bar right here, this is this narrow range weekly bar referred to in the standard world, the retail public model world of standard technical analysis, is that's a doji reversal. It's indecision. How does it confirmed in that public model is that it has to gap up above this cross, this weekly price action. It's narrow. You gap up above it with strong price action volume. That's how you confirm it. Okay? And another thing is that the MACD sell signal is very narrow at minus 1.75. Nonetheless, the prior week it was 2.9. And this is all earnings related naturally. 8.39, we can see the decline from 21.83 when we were opening over here on 227 of 2011. We were opening at 610 and making highs at 619. The lows at that time were 595. This is all on a weekly level right here. So you opened there, you made highs there, but look at what the weekly low was. And then the weekly close was 600 naturally. So during the earnings season, we had made a great recovery off of the bottoms, but here's the problem now, is that the bigger money is either going to get sold out here or more fear and panic down to the 200-week moving average. The 200-week moving average for the public model, that weekly moving average, is what they're going to look at, and that's 505.1778. That means that should we come down that way, and if we do not have the reversal gap up, we are going to come down that way, then that means that the current call option market is going to lose more value. That means that the put side of the market would gain more value. Should this be the case, it would warrant a immediate execution within the volatility intraday, making sure that put side of that market, because if we're going to go down and test it and we're headed that way, then that put side of that market is going to go up in value now. So we need to be coherent to that. We need to be very mindful of what that bigger money, how do they make decisions, what is their public model versus you as an MMT. You're a market maker. That's like, okay, well, here you go, Mr. Public So-So. Now, you understand what their thinking is going to be before there is. You don't hear any uncertainty in my voice, do you? Not one bit. If you're looking for that, well, go on the internet, man. It's all full of that crap. What we're talking about, that you're going to have to gap above this narrow price range weekly movement. If you don't, and it starts to slip below right here on heavier volume, then we're headed north down here to 505.17. If we come down and test that 200 week, that means that this weekly percent DS will get into such a oversold condition that you have to buy it at that point. Not only that, the short sellers, the big short sellers around the country on Google, hedge fund managers, that big money that trades Google is going to buy to cover here. So we would get a massive bounce when it hit there. That would be when the put side of the market would finally have peaked that side of the price, and we would finally met the very bottom price action in the call side of the market. And that's exactly how this will happen. One of the key factors, though, is understanding that sell side public model, buy and sell decision model. Whereas the SMF market maker is the exchange model. That's totally different. There's no comparison between the two. And it's how we operate that bid and that ask between the public buyer and seller is what really distinguishes SMF market makers, because those are the people that control the bid and the ask as a buyer and seller all day long. So on every macro level that we have here at SMF and every longer term level, so from micro to expansion levels, is that this is the trade management that we will be exercising on Monday morning on this wonderful Easter weekend. Everybody, this is an Easter present to you. So basically, make sure that you're buying right where they're going to cover on the 200 week. That will be when you're finding those Easter eggs. Should it go that way? If it does gap up, and MMTs, we will be using our SMF platform weekly charts so that you can see the mathematical price action market maker lines all the way up on a weekly level, which is a delta level. And basically, this is the way that this is going to trade. So you can get into oversold at 16.97. However, you can also just like get to an extreme oversold area, which would happen there, and just like you get extremely overbought names. They're, whether it's extremely oversold or overbought to sell short. So when they're overbought, you're selling short, and when they're going to get really oversold, then you're going to be going long. So this is what we're going to be monitoring in the upcoming week. And the amount of selling, what they have done during the earnings is really uncalled for. Valuations relative to S&P 500. We have also had Brian Plain do some very good work over here on this public chart model. Brian Plain took the Nasdaq and Google chart. Here, let me get it. I'm going to bring senior analyst Brian Plain in, who understands the public model versus the SMF market maker model, because he's been here going in his 7th year. And he put together a very, very good way of looking at the Nasdaq 100 and Google Inc. So, Mr. Plain, can you tell us a little bit about the kind of work you did relative to performances, and what would be the whole trade management scenario about buying beaten down and looking at the top and relative to performance to the indexes that Google trades in?
Sure. What we have here is a combination of the Nasdaq 100 relative to Google. And you can see that the Nasdaq 100, that is the top section up here.
Okay, where are you pointing at?
Right here in the 40.
So do you want to take control of the mouse here?
Sure.
Okay.
So right up here where this top trend line is,
yes,
this is your Nasdaq 100.
Okay.
And this lower one with the bigger bars, that's Google.
Okay.
And so when you go back to, say, 2010, they were trading more in line with each other, and then they ran up together. And you see this huge gap up here. This is Google when it gapped up, and you could see the MACD readings,
yes,
and how they peaked right up here.
Yes, I did.
And right after that, the stock collapsed and actually cut into underperforming the Nasdaq 100 for a slight amount of time.
Uh-huh.
And from there, it caught back up, traded right in line with it, right until, right here in January 2011.
Oh.
And then it got whacked down a couple times, down to this 2392 trend line.
That's right.
And the Nasdaq 100 started breaking out higher, and it went up as well, but it had already had that big bar down.
Correct.
So it had led the underperformance. And then the Nasdaq 100 gap down, Google started breaking down as well. And you can see that this trend line here with the wick right here.
Yes.
There was one on the Nasdaq 100, but the Nasdaq 100 was still outperforming at that time. And so from there, then you had a move up on the Nasdaq 100 and Google as well. But the difference of how much the Nasdaq 100 was up relative to Google was starting to grow there.
Right. So what you're
And then
saying during that time frame, no matter what, the Nasdaq 100 was still outperforming one of the peer leaders in the Nasdaq 100.
that's exactly right. And then we had the earnings the other week where we had the big drop,
Which
and you
was
can see
right here.
and you could see that the Nasdaq 100 had a green bar.
Up, it had a gap up. When this was
Mhm.
gapping down, the Nasdaq 100 was gapping up to come back up to all-time highs on Nasdaq 100 here, and Google was gapping down to all-time lows. What an underperformance Google is, and what an outperformance the broader Nasdaq 100 is. So, do we buy equities that are at underperformance levels that are leadership as a pair
Yes, we
trader?
do. And if you notice the MACD bars, they haven't been this negative since.
Are these daily MACD bars here?
Yeah.
Oh, you're down to readings that are very extreme lows. Because when you take a look at your overlay here and you take a look at Google's standard weekly chart, we can see here, like I said earlier, you're minus 1.7 on a weekly level. But on that daily level, you're starting to hit to a point where that can't go any lower. And then when they start to reverse and go higher, once once it overshoots its oversold condition and it turns, then that's when the stock is finally going to start to make its move up. Is it possible, Brian Plain, by looking at the NASDAQ 100 outperformance and Google's underperformance to the NASDAQ 100? So if we say that the NASDAQ 100 is going to have a correction now from its bear and its bull trends in this area of the NASDAQ 100, okay, and this is Google, like you said, let me ask you this. Because we can get to such an oversold condition here, the NASDAQ 100 could actually be gapping down and Google could be gapping up. Just the invert of what we're talking over here. When it was gapping down, Google, and underperforming the NASDAQ 100, the NASDAQ 100 was outperforming Google by gapping up. Well, could there be the same kind of correlation when you reach such an oversold condition that Google could start to outperform the NASDAQ 100 as it's correcting? Is that possible?
Yeah, absolutely. I mean, we've seen it time and again when, the Nasdaq 100, Google will lead it higher and then lead it lower, but sometimes they stop going in that correlated fashion where Google sells ahead of the broader market and it's already down there,
Right.
and everything else didn't get that correction, and so you see a lot of sector rotation within the sector where they're going to sell names like Apple and they'll buy names like Google.
Right. So as a pair trade, you're selling the oversold good news and you're buying the asset value on Google down toward the bottoms of a very oversold deep condition based on a lot of hyper volatility in the earnings when they blew out the revenues in that quarter. So that's what we're going to be looking at. Would it be safe to say, though, that next week, if this weekly standard cross right here, weekly price action, if we don't get a gap above it, then the chances are we're going to come down to this 200-week moving average, and there's going to be more of a weekly sell signal that would take place, and the weekly percent DS down here at 6.97 drops down to 12.5, which would make Google an all-time buying opportunity because the hedge fund managers and institutional managers are going to buy the cover there. Would that be safe to say? And that we would be putting a blow off top before the NASDAQ 100 does roll over in the next 45 days?
Yeah, absolutely. And one of the things too is the average analyst consensus for 2012 earnings for the year is 39.62, and you're trading at 13.25 times that number. And these people love to buy growth. And this is an opportunity for people to get that growth and all those costs that they had in this quarter And especially if the high end comes into play, which is 45.31, and these are all recently taken down as well
Right.
based on that last earnings report. But 45.31, if you're trading 20 times that forward looking number, would be $906.20. So we'll see based on valuation if people still want to keep piling into Apple, make it a $400 billion stock, or if we're going to see some of that money relocate to other areas within the sector.
So would it be safe to say that valuation relative to the S&P 500 and the Nasdaq 100 total earnings combined with looking at what the valuation is on Google is that valuation is where the big money is going to have to start buying? Based
Exactly.
on
And
2012 projections is what you're saying. So what you're saying is because when you had worked at Fidelity for all of those years, that's the exact type of fund manager thinking, public model. So what is some of their, these are their thinking patterns and what they're trained on. Is that correct?
that's correct. They're also looking at things like how many dollars below the 200-day moving average am I buying? How has Google performed over a 52-week period relative to, say, the Nasdaq 100, and it's down 4%. So
Okay.
they're gonna look for things where they can find value and provide value for their shareholders.
So would it be safe to say that the bigger money that buys Google for longer term investments is buying a depreciated percent drop value relative to being on par with the current index values?
Exactly, and they could have bought some at higher prices as well, and they look at this as an opportunity to dollar cost average to get more shares to, reposition themselves at better price levels than when it was $115 higher.
So what we would be looking at then, and not only that, when we look at under asset values versus relatively overvalued assets, as far as going long, and these columns over here, these are ratio columns that hit certain levels, that's where they start buying. So what I would say is it would be safe to say that we're probably getting closer to a bottom at the 200-week moving average at 505. And right now, Google closed at 525. That means that there's still the last part of the sellers, the panic people that sell out at the bottom, will be selling out at the bottom. And then we're going to get a huge bounce and a huge new growth of buying opportunities hitting this name. Is that correct?
That's correct. Yeah, we're going to be looking for the washout. They sell
Okay.
them down to buy them. They want to take out stop losses. They want to get the people that are, in at higher prices. They want them to just exit their position.
Okay. Having said that, then what we will be doing in our other live trade management videos, that means live, not after the fact, is that we're clearly going to map out where the $500 call option would come into play and what kind of pricing structure that would be, which will be done in another live video for the SMF MMT option market makers live. That will be a private reserve video for those MMTs because this is how they make their living. And because of the fine work that they do and the fine efforts that they put in, and they have many other tools that SMF has designed over a number of 25-year period, we have developed many tools that are accurate as to where we would be buying and selling and taking the other side of that public reaction, and then how we profit all the time off of the public reaction, and understanding and knowing how their decision processes work is what empowers the SMF market maker. So I'm going to conclude this special video series and analysis on Google on this very fine Easter weekend